Hi everyone, welcome back to the US CPA classes for business analysis and review examination. This particular video is in continuation of the earlier video. So this is part 2 of the business analysis. Here I'll be walking you through in continuation of part 1 about investment alternative using financial valuation and decision model. More specifically, we'll be covering assets and investment management. So let's understand more in detail about investment alternative using the financial valuation and decision model part 2.
Hey everyone, welcome to the BR classes. So we are in chapter 2, investment alternative using the financial valuation decision model. So yesterday we started with this financial valuation method and decision model, and we have covered this valuation fundamental, which include like fair value basic. We have also discussed about approaches to determine the fair value, and parallelly to the respective approach we have covered the assumptions topic as well, right? And then we have discussed about fair value hierarchy and the disclosure requirement. And the last topic which we have covered is the valuation methods. So capital asset pricing model and the dividend discount model or dividend growth model we have already covered above. So yesterday we have finished off this Black-Scholes model. So today we'll be starting with the fourth topic, asset and investment management, and then we'll jump onto the capital budgeting. That's slightly bigger topic. So we'll try to cover both this topic today, and if time permit, then we'll see how we can jump onto the another topic. So today class would be slightly shorter than like normal class because I'm feeling over exhausted. Sorry about that, but we'll finish off these two topics so that your 2.2.3 is completely done from your side, and then you can do the practice also, right? So if you remember, like on the valuation fundamental, we have discussed about ASC 820 fair value basics. In that we have discussed what all things we need to consider when we do the fair valuation. Then we have discussed all the three approaches: cost approach, market approach, income approach, and all the requirement for them. And then after we jump onto the fair value hierarchy in ASC 820, which is level 1, level 2, and level 3. And then we have discussed about disclosure requirement. After that, we did few practice question, and then we jump onto the valuation method. And that we have covered this Black-Scholes model, and remaining two models we have already covered in the earlier classes. So till this page we have done yesterday. Now we are starting with the fourth topic, which is asset and investment management. So when you think about asset, or when you think about investment, and when you think about managing the asset and investment, right, what comes in your mind? Someone who is managing the assets and investment more effectively and more efficiently so that asset and investment can give appropriate return on investment, right? Make sense? So the asset management is basically a process of developing, operating, maintaining, and selling the assets to generate the sufficient ROI, right? So investment management is handling financial assets like your stocks, bonds, mutual funds, securities, etc., and other investment like real estate by the professional for client. So if you see, like many big investment management company like BlackRock, if you have heard of, or maybe like if you see wealth management company, almost nowadays if you see most of the banking and insurance company do have their wealth management department separately, as well as investment management department separately, right? So those company do management of the funds of other people, right? It can be individual, or it can be of company, or it can be a partnership firm or a sole proprietorship firm, right? So such companies are generally called investment banking company, investment management company, wealth management company, asset management company, right? So their job is basically to identify the right investment, develop the plan, operate them, maintain them, and sell them as and when they see the profit are increasing, right? So investment management include devising the strategy and execute the trade within the financial portfolio. So they do the portfolio management. Have you heard about any such company? do
Yes, sir.
portfolio management or investment management. Any
Yes,
names
sir.
you would like to share?
So like Finance is one of the
Mm-hmm.
platform where we use to where we are able to buy mutual funds as well as investment
Mm-hmm. Mm-hmm.
things over there.
Mm-hmm. Would you like to share a few names?
So Finance is what I know.
Mm-hmm. Mm-hmm. Yeah. And then I think, like many of the
BlackRock.
BlackRock, yeah, that's very true though. And in India also, like many mutual fund companies, like they also have like separate division of wealth management, asset management. Almost all the bank, whether it's like ICICI, HDFC, Axis Bank, they also have like wealth management separate division, right? So what they do, they identify the good investment opportunities, they manage and maintain your portfolio, and they sell when they see there is a good profit generating out of those, right? After discussing with you, right? So those kind of companies are called investment management company, right? The main goal of investment management is to safety of the funds and other assets which they are investing and generating maximum income and capital gain. So there are two things. One, where they are making investment, they make sure like investments are safe. Second important thing, how they can maximize the return on respective investment, either through the income or through the capital gain. So income by using daily trading, right? Capital gain by making long-term investments, right? So the portfolio management and investment process involve deciding which assets to include in the portfolio given in the goals of the investor and changing the economic condition within which the portfolio is being managed. For example, like if any individual, like he or she may be expert in any domain or have interest in any domain. For example, like normally if you see in India, most of the people do investment in real estate rather than stocks, shares, mutual funds, and all those things, right? You'll see a lot of people who are managing and maintaining the real estate, right? But there are certain individuals who may be interested in investing in specific industry. So for example, some people only do investment in pharma, some people do investment more in banking, some people do investment in natural resources, right? So it depends on the taste and preference of the investor and which category or which industry the investor wish to make the investment, because like generally investor make an investment in the industry of which they are aware of, which they have experience about it, right? So it involves deciding which assets to include in the portfolio given the goal of the investor, right? Goal of the investor may set the goal to the investment management company, maybe about the industry in which we need to invest. Second, what is the ROI, minimum ROI he or she is expecting, right? Accordingly, the portfolio manager or maybe investment management company, they need to identify the respective stock, and accordingly they need to go make a mix and match how much investment in, you can say, the top 50 stock they need to make, how much investment they should be making in the mid cap, right? And how much investment they should be making with the lower cap, right? So according to the risk appetite of the investor and the desired goal of the investor, investment management company to make the investment on his or her behalf, right? So things to consider for portfolio management and investment process. So when treat yourself like you are a investment management company or you are an investment manager, right? In that case of scenario, you are visiting or you're meeting with any of your client who has given you to manage and maintain a fund of, let's say, $1 million, right? So let's assume the individual has a taste and preference to invest more and more in pharmaceutical company or healthcare company, right? Then what, as an investment manager, what we will be doing, we'll be identifying the portfolio and mix of the pharma companies which are, you can say, good and stable company, are in top 10 or top 15, some from the mid cap and some from the lower cap, and then based on the risk appetite of the individual investor, you'll be selecting certain investment. right? So what all things you will be keeping in mind? First is market timing, right? Timing is very important. How many of you play cricket by any chance, or any other game,
Yes, sir.
right? Yeah, anyone else, football or cricket, anything you guys play? Arun, do you play anything?
Cricket and badminton.
Yeah. So what is the most important thing is the timing, right? When you need to hit the ball or when you need to hold the catch, right? If you are keep your hand open and ball comes and you have not closed your hand, then you will lose the catch, right? Same way, if the ball is coming at the right timing, you have not hit the bat, it will not go anywhere, right? Or it may result into bold. Same thing here also, investment also, the timing is very important. At what time you need to purchase it and how long you need to hold it and at what time you need to sell it, right? Any of you by chance do investment in shares or bitcoins?
So mutual funds I invest.
Yeah, in
Which
stocks.
in stocks you do?
Yeah,
Right? So you maybe do you mind sharing some experience why timing is important for investment
yeah.
purpose?
Of course, we need to take the correct point of
Right?
breakout chances, and
Maybe any
we need
example.
to sell our stocks at the correct time when the
Mhm.
target hits.
Mhm. So generally, when you make an investment in stock or mutual fund, so as an investor, what is in generally in your mind? How much return I should be expect out of it, right? Isn't it?
Yes.
Yes, sir.
So accordingly, you will wait for the right time to purchase it when the stock price will go down, and you hold it till the right time when stock price go up, so that you can sell and make your desired margin out of it, right? So first and foremost important thing about the consideration is the timing to buy, sell, and hold. Second thing is investor is looking for active investment or passive investment, right? Kashish, you are saying you do investment in mutual fund. So generally you might be making a long-term investment, right?
Yes, sir.
So you are like a passive investment. Whereas Matthew, he might be doing like trading of the stocks, right? That is more called active investment. So you need to understand the investor is of which category and which type of investment the investor would like to make. He wants to make more of like quick day trading, or he is being a long-time investor to invest in mutual fund or invest in any stable stock or invest in any real estate. Third thing, what you need to keep in mind is the publicly available information and the fundamental analysis. Right, all the listed company on the stock exchange, they mandatorily have to submit or has to publish their financial statement on their own website as well as to the respective stock exchange website, right? So their financial information and the latest quarterly results are being available into their website. In addition to that, financial analysis report is also being available in the respective stock exchange for the respective stock. So before making any investment, it is always good to take a look at the financial position of the company and more importantly, financial analyst report. That will give a lot of insight about the company, which you may not get just through the website or just through the financial statement of the company. So financial you can say analyst report is being very important and has very good insight about the respective company. So before making an investment, you need to be comfortable or you should have an idea about the information which is being available at the marketplace so that you are not making a blind investment, right? Fourth is market index, right? You need to consider the market index. That is also very important. Like S&P 500, Nasdaq, Dow Jones, these are like very important market index which give you the indication where like the market is moving. Same way like every day in the news in India, you might be hearing Like BSC has gone up, gone down, NSC has gone up, gone down, right? So those information is also very important to understand the sensitivity and the direction in which overall Sensex is moving. Fifth is investors performance measure and the goal like short-term profit or long-term gain, what investor is actually looking for by making the respective investment, right? Sixth is investors risk-taking capacity. So this is also very important. Like some investor do invest, like for example, in the mutual fund or in the secured securities, which is like government bond, municipality bond, right, or the real estate where they feel they have something real in their hand. Some are, you can say, the moderate, right, who do certain investment into the fixed interest bearing bond, but they do also investment in some top cap, mid cap, and lower cap companies. In addition to that, there are certain aggressive investors like who have more risk appetite or risk taking capacity or risk taking willingness, right? So those investors may also make investment in small startups, in the small size companies or mid cap company more than the you can say large top 50 companies, right? So you need to understand which category of the investor is it, right? So according to the risk appetite of the investor, you will be taking the decision for investment on his or her behalf, right? Seventh is investors' current and expected future tax status. So, any of you have studied regulation by any chance? Not yet. Okay.
No, sir.
So, tax status is basically whether you are a citizen of United States of America, green card holder of the USA, or a resident alien of the USA. Right? In that case of scenario, global income is being taxable in US. Whereas you will get foreign tax credit, that if you have paid any taxes outside the country, you will get the credit if both the country have tax treaty. The other thing is non-resident alien. For example, people like us who visited United States of America first time and who do not meet the residential requirement. For us, the taxable income in US is only that income which we have earned in United States of America, right? Outside US income is for us is not taxable in United States of America, but for the citizen, green card holder, and the resident alien, their global income is being taxable in United States of America, right? So you need to understand what is the tax status of the individual or of the company or of the partnership firm for whom you are managing and maintaining the investments, right? Next is determining the appropriate group of asset. What asset class are to be included in the domestic or international investment? So this is also very important, whether you are making investment domestic or you are making investment internationally, right? Accordingly, the classification you need to give and accordingly risk you need to assess. So these are, you can say, illustrative item, but not the exhaustive limit list of the things which you need to consider. So there would be many other things which you should be considering, but these are kind of basic check at least which you should be considering when you are making investment decision for any client, right? So what we are, investment advisor, investment management company, right? What all things we should be considering in mind? The very first thing is the timing. Second is active investment or passive investment. Third is publicly available information. Fourth is market index. Fifth is investor performance measurement. Sixth is investor risk-taking capacity. Seventh is current or expected future tax rate. And the last one is appropriate grouping of asset. Right? Any doubt so far? Clear?
Yes, sir.
Okay. So measuring the portfolio performance, if you see, we are in the assets and investment management. So first we understood the definition, then we understood the goal of investment, then we understood portfolio and investment process, then we understand what all things we need to keep in mind. Now we are in the next topic, which is measuring portfolio performance. How do you measure the performance of the portfolio which you have created? So who we are? Investment management company, right? So what we are doing here, measuring the performance of the portfolio which we have created for the respective client. Success of the portfolio should be measured in terms of the following. First is whether or not return was commensurated with the risk taken. That means if you remember in 11th standard in your business study book, you might have studied first thing that risk and returns goes together. Risk and rewards moves together. Do you remember that line?
Yes, sir.
Right? So same thing applies here also, whether or not the return was commensurated with the risk taken. So whatever the risk you are taken, and according to the risk category, whatever the return are as per the market norms should be there, whether you have achieved that return or not. Second thing is how return compared to with those achieved by their peers. That means how much returns of your peers have achieved for the same investment. For example, like let's assume Kashish is an investment management company, right? Kashish is an investment management company, and let's assume Arun and Matthew are their clients. So Arun has given $1 million and Matthew has also given $1 million to Kashish to make an investment. But Arun said, I would love to invest in infrastructure company, whereas Matthew says, I would like to invest in pharmaceutical or healthcare industry, right? So accordingly, Kashish has made the investment in some top category, some mid cap and some lower cap, right? For the infrastructure, he has consumed $1 million, and on the other hand, for Matthew, $1 million, he has invested in pharmaceutical company, right? So after a year, you will see what is the performance is being, what is the return on investment is achieved by Matthew's investment, and what is the return on investment is achieved by Arun's investment. So that you can do a peer comparison. Third is whether the success was due to skill or luck. This is also very important. Like what luck can help you one time or two times, but in long run, skill will help you, right? So you need to keep in mind you have done a proper fundamental analysis when you are making investment for any particular company, right? Return must be adjusted for risk before they can compare meaningfully. So what you need to do, the whatever is the return minus the risk premium will be your actual return on the investment. So that you need to compare from one investment to another investment, because the risk category for the various type of asset may be different, right? So far so good, measuring portfolio performance. Shall I move on to next page? Okay, next is measurement of risk method. So there are three, you can say, measurement methods or index. First is tenure index method, second is sharp measure, and third one is genesis measure. Tenure index is portfolio return minus risk-free rate of return. What is the risk-free rate of return? That is a government bond rate of return, right? The normal rate of return which you get on fixed deposit or any government bond, right? And what is beta? Beta is systematic risk or market risk, right? What is the formula? Portfolio return, how much return you have achieved, minus the return on risk-free investment. So that is your delta. That means that is the premium which you have achieved by making investment in riskier investment opportunity, right? And divided by beta, whereas beta is systematic risk of, or you can say material risk, right? Greater the index line, the better the return, risk return trade-off, right? As and when the risk, as and when you can say the index line will increase, it result into more and more positive return on the risk you have taken, right? So tenure suggests that there are two components of risk. One is market risk, second is individual stock risk. Market risk is which is not in your control, stock risk is which is in your control, right? It indicates how much return on investment earned for the amount of risk the investment assumed, right? Sharp measure is portfolio return minus risk-free rate of return divided by standard deviation, right? So earlier it was divided by beta, which is systematic risk. Here you are dividing by standard deviation. So remaining things are same, right? This is very similar to the tenure index, except the risk measure is standard deviation of the portfolio, not the beta. Therefore, standard deviation is equal to systematic risk plus unsystematic risk. So it covers both systematic risk as well as unsystematic risk that is specific to the industry or the company, right? Clear so far? The first one is tenure index, right? Tenure index is portfolio return minus the risk-free return divided by beta, whereas sharp measure is portfolio return minus risk-free rate of return divided by standard deviation, and standard deviation cover both systematic and unsystematic return. Third is Genesis measure. Genesis measure return on portfolio is equal to risk-free rate of return plus return on market index minus the risk-free rate of return multiplied by beta component, right? Beta is again systematic risk or market risk. So it measures absolute performance on the risk-adjusted basis and measure the portfolio manager predictive ability to achieve higher return than expected for the level of risk accepted in the portfolio, right? Any doubt on any of these three models? So far so good.
सर एक बार जेनसन मेजर का एक बार example.
So Jensen measure is very simple. Risk-free rate of return, that means your you can say municipality bond rate return or government bond rate of return, or like fixed deposit rate of return in which you are not having any risk. Plus return on market index. That means in the which market you have invested, what is the average return from that respective market index, right? Minus the risk-free rate. So divide by, multiply by the beta. Beta is your systematic risk of systematic risk or market risk, right? We'll do certain calculation. You'll get to know more about it, right? We need to do some illustration to make ourselves familiar with all these three formula, right? So let's do a practice question together. It was time for an investment advisor to meet with one of her major client for annual review of his portfolio. It means, for example, you are an investment advisor and you have a client and you'll be meeting with him to discuss the portfolio. She knew that the investor would be very interested in the performance of his portfolio in the turbulent and volatility market that had existed in past 12 months, right? If you have made certain investment through the bank for any mutual fund or any stock of the respective company, then you will be interested in knowing from the bank how things are moving, right? So she reviewed the client file and saw that the that he had indicated that he expect his portfolio would provide him with a risk-adjusted return that provide a high portfolio return per unit of risk. She picked up the phone and called one of the firm's analysts and asked him to complete an analysis of what? Which one is the right option? Are you guys here?
Yes, sir.
So which option you feel is the right option? What is the call of the question? She picked up the call and called one of the firm analysts and asked him to complete the analysis of the dash for the portfolio. So what she is doing, it was a time for an investment advisor to meet with one of the major client for annual review of his portfolio. She knew that the investor would be very interested in the performance of his portfolio in the turbulent and volatile market that had existed in past 12 months. She reviewed the client file and saw that he had indicated that he expected his portfolio would provide
Jensen
him.
लग रहा है answer.
Huh?
Jensen major.
1 second. Just see this again. This line. She reviewed the client file and saw that he had indicated that expected his portfolio would provide him a risk-adjusted return that provide high portfolio return per unit of risk.
Jensen major.
Anyone else? Any idea?
But if you see the last para of Jensen major, it is already mentioned.
So it measures the absolute performance on risk-adjusted basis and the measure the portfolio manager. Yes, you're right. So second option is correct. Jensen.
Because third is written.
It indicates how much return on investment earned for the amount of risk on the investment assumed. No, third is right.
No,
second is
third
right. Jensen is
yes, sir.
right. Okay, so this is about measurement of risk, right? This is like we are done with asset and investment management. Now we are jumping on to the next topic, which is capital budgeting. But any doubt before we jump onto the new topic? Sorry. Asset and investment management. Any doubt you guys have?
No, sir, clear.
Okay. Next is capital budgeting. This is slightly bigger topic. It is a process to evaluate the potential measure of the project capital, investment, add new product, service or market, or extinguishment or refinance of any debt. So when you do capital budgeting for such bigger things, for example, like any bigger project which you need to take and for which you need to make a capital investment, any investment, joint venture, subsidiary, merger, acquisition you are making, or any new product, service line or market you are entering into, or if there is any extinguishment, that means you are paying back the debt or doing the refinance of the debt. So such kind of major decision required capital budgeting, right? So what is capital budgeting? As the name suggests, it's about budgeting the capital requirement for the future, right? So the relevant data is the only useful in capital budgeting. So do you remember what is relevant data? Any idea what is relevant data?
Sir, which is relevant to the particular situation.
Yeah, which is
Or
relevant
information.
in taking up the decision, any particular decision, right? Do you remember what is sunk cost?
Yes, sir. पढ़ा था सर ये सब.
Yeah, sunk cost is the cost which you have already incurred and you have no influence on the current decision or future decision. Right? That is also very important. That means the expenditure or activities which you have already done. Right? If the activity you have already done, then for future in taking up the decision, that is not relevant information. If the investment you have already made, if the expenses you have already made, those are not relevant for decision taking, right? So relevant data is the only useful in capital budgeting. Data for capital budgeting is relevant only if it is affected if it is affects the cash flow, like initial investment or future net cash inflow or net saving in the cash outflow is relevant data, whereas depreciation on existing machinery is a sunk cost, that is not a relevant data and not relevant for capital budgeting, except it become relevant as they relate to tax impact of depreciation, right? So there may be possibility that it may have tax impact which you have already incurred the cost, so that tax benefit which you are getting might be a relevant data for you, right? Second thing is time value of money. Do you know what is time value of money? Any idea what is time value of money? This concept I think we have touched base many a time. Do you know what is present value? Yes,
Yes, sir.
no.
पढ़ा हुआ सर.
What is present value? Why do we use present value?
Sir, in order to predict the value of the future.
No.
That is.
Harini, Arun, Matthew, any idea?
No comment. I heard of it, but I don't remember.
So present value, do you remember like NUT question you might have done in your school days?
Yes.
Right? So that NUT table is basically the present value table, right? So it means time value of money means if you have, let's assume $100 today, right? For the $100, let's assume you can purchase 5 liters of milk. After a year, in the same $100, right, your purchasing power may go down and you'll be able to purchase only 4 liters of milk, right? So the time value of money is you reduce your money value after some time because of the inflation impact, right? That is called time value of money. So how do you calculate the time value of money? Is through the present value. That means today $100 is worth $100, but after 1 year the $100 may be lesser value. After 2 years it is further lesser, and after 10 years it may be much lesser. I'm sure like some of you might have heard from your parents like this land was worth like this much amount 10 years ago or 15 years ago or 20 years ago, but now it's in crores and crores, right? I'm sure some of your friends, family member might be discussing such thing, right? So what is changing is the time value of money. The value of money is decreasing period over period, right? Make sense?
Yes.
Got it? What is time value of money? What is the purchasing power of the money today? It will reduce slowly and gradually period over period, right? So the money, for example, today for $100,000, you can purchase a piece of land of small piece of land. But if 5 years ago you might have having $100,000 in your pocket, you might have been purchased slightly bigger piece of land, right? So your purchasing power is reducing period over period. So that is called time value of money. And for the calculation of present value, you use present value table, right? And present value annuity table. Make sense? Clear, Kashish?
Yes,
Arun?
yes, sir. Clear.
So time value money is very important for capital budgeting. Capital budgeting technique that use time value money are considered preferable technique. Time value of money account for difference between $1 investment today and $1 return sometime in future. That may be on account of inflation impact or the opportunity cost which you could have been considered to invested the same amount somewhere else. Right? Future value. So there is a formula to it. The future value of any particular asset or particular investment is equal to P bracket 1 minus I the power n. So P where is sum of the money invested today, I is the interest rate, n is the time, and present value is P, right? So the P is equal to future value multiplied by 1 divided by 1 minus I the power n. So these are two formula which we'll be using more frequently in the illustration which we'll be covering. So I would request all of you to please remember this formula. This is very, very important, right? Future value, that means if today you have $100, what will be the purchasing power or what will be the value of these $100 after 5 years? Right? If assume you have rate of interest 10% or you have discounted rate is 10%. How do you calculate that? Just note down a question. Let's do illustration of our own. Are you guys with me?
Yes, sir.
So today you have $100,000. That is P is equal to $100,000 and interest rate is equal to 10% and the time is 5 years and the present value after 5 years is 0.691. So what is the future value of $100,000? What is the future value of $100,000?
Sir, interest rate is 10%.
Interest rate is 10% and 5-year present value factor is 0.691. Is it difficult? You
No,
need
sir.
to apply this formula. F is
So
equal to
calculator, sir.
P multiplied by 1 minus I की power n.
So 100,000 is equal to 1 upon 1 minus 1.1 to the power 5. So that, sir, अभी calculator है नहीं, so
Now you have your mobile.
sir mobile में I can check.
It's very simple. 69,100.
Okay.
Right? So annuity are of two types, ordinary annuity and annuity due. Ordinary annuity is generally considered to the annuity in arrear. That means the amount receivable or payable after the period, right? So it can be, like your EMI, which is monthly payable, or installment or monthly payable, right? So those all comes under the annuity. So annuity are of two types. One is ordinary annuity, which is generally considered as annuity in arrear. That means you have already availed the benefit and every 30 day, every 60 day, 90 day, 6 months, depend on, like the financing arrangement, you might be paying it back. Or it can be annuity due. So if you remember, like bank loan, so they take first EMI immediately, right? So that will be the day the loan is starting, you have to pay the EMI, right? Those kind of annuity is called annuity due. So annuity in advance. So ordinary annuity, it is the series of equal cash flow received or payable at the end of equal interval of time. Annuity due, on the other hand, is a series of equal cash flow received or payable at the beginning of equal interval of time. So difference is at the beginning or at the end of the period. Right? Clear? Shall I move on? Future value of ordinary annuity represent equal annual payment received at the end of the period that are accumulated and earn interest. In another word, it will be value of the series of payment that are compounded at a given rate of interest at any point of time in future. So the future value is equal to payment multiplied by 1 minus I the power n minus 1 divided by I. FVA is future value of annuity and PMT is payment of each annuity. So generally, this all calculation result is being given to the in the question. You are not required to do all this mathematical calculation because these mathematical calculation are part of actuarial exam, not CPA exams, right? Next is present value of annuity. Present value of annuity is the value today of the future series of payment discounted at a particular interest rate. Like same way, like for example, if you have given any loan to someone and that person is paying you monthly EMI. So in the monthly EMI, he would be paying principal and interest both, right? So how do you calculate the present value of the total payment you are expected to receive in the form of EMI? So the present value of the annuity is the value today of the future series of payment discounted at a particular interest rate. For example, you have interest rate of 5% or 10%. So you'll be taking from the annuity table what is the 5-year annuity table demonstrate for the respective percentage of interest. For example, for earlier example we have discussed, it is 0.691 if it is 10% for 5 years. Same way, the annuity table will be given to you in your exam. In the annuity table, you can go and cross-check. Compounding interest. Compounded interest, when dealing with the capital budgeting problem, assume that interest is compounded annually. That means when you are doing capital budgeting, it is a basic assumption or presumption that interest is used to be compounded interest, not the monthly, quarterly, semi-annually or annually interest which is payable. So it is generally considered as compounded interest, right? Assume that in problem you may see interest stated at an annual rate but paid semi-annually, quarterly or monthly. In these cases, the interest rate and the number of period must be adjusted when making the calculation. So you need to make an adjustment for the number of period as well as interest rate. So the capital budgeting technique or method, there are couple of methods and technique which is being used for capital budgeting. First one is payback method. Second is discounted payback method. Third is ARR, which is accounting rate of return. Fourth one is net present value. Fifth one is internal rate of return. And sixth one is profitability index. Seventh is cost variable price index. Right? These are like 7. Yeah. These are 7 ways. So we'll be covering these 7 ways and then we will close for our day. So today we'll be covering this entire topic.
Sir, how many numericals we are expecting in this?
Sorry?
Sir, how many numericals we are expecting in this particular?
Yeah, you can expect maybe 2-3 questions at least in your exam from this topic. And we'll be doing illustration and we also do practice question for each category of you can say capital budgeting technique. So
Okay.
the first one is payback period. Payback period is basically demonstrate in how many months, how many days, in how much period you'll be receiving your money back. So it does not use discounted factor, right? It just says total investment required divided by annual cash inflows or outflow, net cash inflow or outflow. For example, investment cost is $20,000 and annual cash flow you are expecting is 4,000 for 8 years. So what will be the payback period? Payback period is 20,000, which is the investment requirement, divided by annual money which you are receiving, which is $4,000. So your payback period is 5 years. Make sense?
So 4,000 to 8 years का है ना?
But in how many years you will recover the entire money? That is called payback period. Right? You will recover your cost in 5 years, and after that it will be your profits.
Okay, 3 years would be the profit.
Yes. So that, as the name suggests, payback period, in how much time you will be recovering your investment. In a very simple or layman language, if I say. Clear?
Yes, sir.
Second is discounted payback. So discounted payback is the period, is the method in which you do discounting of the cash flow which you are receiving, right? So discounted payback is the period in which initial investment is recovered with discounted cash flow. So in this example, initial investment is $10,000. Actual cash inflow is $5,000 for 3 years and discount rate is 10%. So in the very first year at 10% discount rate of $10,000, how much money you will be receiving? So you have given
1,000.
present value factor 0.9091, 0.8264, 0.7513. Right? So $5,000 for year 1, $5,000 for year 2, $5,000 for year 3. So total money which you are receiving is 4545 plus 4132 plus 3756. So that is the total money which you are receiving. How much is that? Can you do the math for me? 4545 plus 4132 plus 3756. How much is total?
Sir, 12433.
12433.
433.
12433. Are you sure? Or should I do math?
Sir, 10,000 को add करना है क्या? नहीं ना?
No, no.
Sir, then it is
4545 plus 4132 plus 3756.
12433.
Yeah, 12433, right? Minus $10,000. So you are receiving, sorry, here we need to calculate the payback period. So payback period is in how much time you will be receiving your initial investment back. So $10,000 in the first year you have received 4545. So remaining balance is 5455.
Yes, sir.
Right? In the second year you have received 4132. 4132 you will minus from 5455. So remaining is 1323. Right? So this 1323 you will be recovering in how many months? If in 12 months you have received 3756. So 3756 divided by 12. How much is it? 3756 divided by 12. So that is 313. So 1323 divided by 313. That is around 4 months, 4.2 months, right? So if you see here, discounted payback period is year 1 plus year 2 plus 1323 divided by 3756. Right? So in year 3, 4 months it will take. So 2 year, 4 months will take to recover the entire investment. Make sense?
Yes, sir.
Next is annual rate of return. Have you accounting rate of return? No, it should be annual rate of return. Annual rate of return. Net cash inflow minus depreciation divided by average investment, or net profit divided by average investment. Average investment is opening investment plus closing investment divided by 2. That is come as average investment, right? So investment, it focus on average income generating by a project in relation to average investment, and it focus on income, not cash flow. So earlier method, whether it's payback method or discounted payback method, they both were focused on cash inflows, right? Whereas annual rate of return focus on return on investment, not on cash flows, right? It does not consider the time value of money. It also does not consider time value of money. No present value is required. So for example, investment is $100,000. Annual net cash inflow for 10 years is $20,000 per annum, right? And you have a straight line depreciation of, let's say, 10 years is a $10,000, right? So average investment is $50,000. That means opening investment plus closing investment divided by 2, $50,000, right? So annual rate of return is equal to 20,000 minus 10,000. What is 20,000? Your annual net cash inflow minus the depreciation 10,000 divided by 50,000, which is your average investment, right? So 20% is your annual rate of return. If ARR is greater than WACC, what is WACC? What is WACC?
Weighted average cost of capital.
Weighted average cost of capital. So if you are getting annual rate of return more than the weighted average cost of capital, then investment is viable. So you can accept that project and move on, right? Next is net present value. So net present value is a method which use time value of money. So net present value method use time value of money, and it will make all the cash inflows and outflows to the present value. So NPV of the established net future cash inflow are calculated by discounting a desired rate of return, that is WACC. An investment proposal is desirable if NPV is positive. It means present value of inflow is greater than present value of outflow, then the respective proposal is acceptable. When several investment proposals are being given, then reasonably similar investment size, then consider in which NPV is high. So you need to calculate the NPV of each proposal and then rank them from top NPV to least NPV, right? The proposal with highest NPV should be chosen. An implicit assumption is that all net cash inflow can be reinvested at a discounted rate using the computed net present value. The method can easily be applied if the annual cash flow is not equal, right? Clear? Net present value. Let's do an example. So investment required is $10,000. Cash inflow in year 1, 5,000. In year 2, 4,000. Year 3 is 3,000. And desired minimum rate of return is 14%, or you can say the WACC is 14%. So the present value of annuity at the 14% is for year 1, 0.877, year 2, 0.769, year 3, 0.675. So the cash flow, present value of the cash flow will be 5,000 multiplied by 0.877 4,000 multiplied by 0.769, 3,000 multiplied by 0.675. That is 9485. So this is the present value of the cash inflow you are expecting from the project. Whereas initial investment is $10,000. So your cash inflow, present value of cash inflow is expected to be lower than the investment. So you will not be making investment, right? Since NPV is negative, this is not desirable investment at 14% return. Make sense?
Yes, sir. Sir, it is somewhere like 10 to 11% if we are getting a break-even point.
Yes, that we'll be discussing in internal rate of return. So that's the next, you can say, method, which is internal rate of return. So internal rate of return is equal to required investment divided by net annual cash inflow. That give you the factor of internal rate of return. So what is the internal rate of return? Where cash inflow is equal to cash outflow. So where they both are zero generally, right? It is the rate of discount that equate the present value of cash flow including initial cash outlay to zero. That is IRR. At IRR, present value of inflow is equal to present value of outflow. Greater the IRR, better the project is. If it is a single project and IRR is greater than WACC, then it is acceptable. If you have multiple projects, then order them in a range of IRR. Highest IRR should be the top order and the lowest IRR should be last one, right? And you can select those projects which is more than the IRR is more than WACC. When more than one project are considered, they are ranked according to the projected rate of return, that is IRR. Discount factor sometimes does not coincide with the annuity table. So extrapolation is often required. So here you will be calculating the factor. The factor, how do you calculate? Is the required investment divided by cash inflow, expected cash inflow. So this will give you the number, this will give you the range, this will give you the age. But actual number you may not get directly from the annuity table. Sometimes you need to do extrapolation or you need to identify within the range to calculate the number. That we'll do through an example. So net present value and IRR method will potentially rank project differently. So both generally give different result if the cash flows are different. If the cash flow period over period is same, then they both give same result. Example here is new machine cost is $20,000. Saving per year for 8 years is $5,000. That means every year your saving remains same, that is $5,000, and the salvage value is 0. So what is the IRR of machine should require? So year 0 you will be paying $20,000 cash, but every year from year 1 to year 8 you are receiving $5,000 saving, right? So the factor of IRR is investment required divided by cash inflow, that is 20,000 divided by 5,000, which is 4. 4 is the factor here. So what you need to see for 8 years, right, when the present value factor is coming near to 4. So here in 18% and 19%, this is coming in between 4, these two, right? One second. So first we need to calculate the IRR factor. IRR factor is very simple. Total investment required divided by annual cash inflow. So that is 20,000 divided by 5,000. So factor is.
How do we get this?
So investment is given in question 20,000.
Okay.
And saving is given in your question 5,000. So 20,000 divided by 5,000 is 4. So now you need to see at what percentage in 8 year of the annuity table comes close to 4. So 8 year is the period and you need to see where it is come closer to 4. that is in 18% and 19%. Right? Here the IRR you need to calculate, which will be in between 18 and 19%. Right? How do you calculate that? 4.08 minus 3.945. Right? How much is it? If you do the math for me. 4.078 minus 3.954. How much is it?
124.
124 base points, right? 1.24 base point. So 4,000 minus 3,954 is how much? 46. So 46 divided by 124. How much is it? Hmm? 46 divided by 124.
0.37.
0.37. So 18.37 will be the number here. Right? So that's how.
How do we get this? 17% we are getting 42.07. The values कहाँ से आई है sir?
Which one? 18.37?
No sir, 18.37 I am able to get, but ये 4.207, 17% पे 18.
This will be given in annuity table. So this will be given in the books, in the question.
अच्छा sir, मैं वही कह रहा हूँ सर कहाँ से आई है value. Got it.
This is coming from annuity table. Right? Next example you have, initial investment is $10,000. Net cash inflow, year 1 5,000, year 2 4,000, year 3 3,000. Right? Solution. First, let's try 10% IRR. Second is 11% IRR. So for IRR 10% and 11%, you will go to annuity table and check what is the discount rate. For year 1, 10%, it is 0.9091. Year 2, 0.8264. Year 3, it is 0.7513. And 11% is 0.9009, 0.88116, and 0.7312 accordingly. So you'll be multiplying 5,000, 4,000, 3,000 accordingly. So the total is 10,105 at 10% and 9,944 at 11%. So your value is 10,000, investment is 10,000, right? So in the first option, 105 is positive and second option is 56 negative. So what is the total? 105 plus 56? 161, right? So 10% plus 105 divided by 161. That will be the IRR percentage. Yes?
Second try में 5,000 में sir value is same, right?
Sorry?
At 11% value is same, I guess.
No, value like cash inflow is same, 5,000, 4,000, 3,000. But annuity number will be different. Right?
Yes.
Annuity table will be given to you in your question. Right? So this is how you will be calculating.
What is 10 here? 10 IRR equal to 10.
10%, which you have at 10%, you have tried first, and 11% you have tried second. So the percentage will be, IRR will be in between 10 or 11%. So that is 10% plus 105 divided by 161. So 10% is a base from where you have started.
Okay.
Right?
Yes.
And then we have portfolio index, CVP. Yeah. So about to close. We have just 2 more pages. Then we'll be closing. Next is profitability index. Profitability index is present value after initial investment divided by initial investment. So profitability index is benefit cost ratio, NPV of the project plus 1 divided by initial investment. So project with positive NPV will be a profitable index greater than 1. So profitability index is often used to compare two or more mutually exclusive projects. When two or more projects you are negotiating together, then you are using profitability index method. The alternative project with the highest profitability index is most desirable. And the last one is cost volume profit analysis. This is called CVP analysis or margin of safety. So CVP analysis is profit is equal to sales minus variable cost minus fixed cost, right? And do you remember break-even analysis which we have done? So that break-even analysis comes under the CVP analysis or margin of safety analysis. What is the break-even point? When your sales and cost are equal. That means we are at zero profit, right? Margin of safety is the point over and above the break-even point. All the profit you are earning over the break-even point is called margin of safety, right? These are the 7 techniques which we have, right? Let me take you quickly, reiterate you all things. Capital budgeting. So in the capital budgeting, for what you will do for the major projects, investment project, new product, new services, new marketing, or extinguishment of any debt or refinancing of any debt, right? So here you have these 7 methods. First is payback method, second is discounted payback method, third is annual rate of return, fourth is net present value, fifth is IRR, and the sixth one is you can say profitability index, and seventh one is CVP analysis, right? So let's do 2 quick questions and then we are done for the day. An accountant using Black-Scholes model to value the stock option has input the exercise price of the option, time to expiration of the option, and interest rate. Which of the following variable also is required for the model? Discount rate, call market price, put market price, or common stock? What will be requiring? Black-Scholes model. That's a yesterday.
Black-Scholes में तो सर call and put option ही होता था ना?
No. Just look at it. 1 second. Call option, put option, but the important thing is stock price, strike price, risk-free rate of return, time of maturity, cumulative distribution function, and volatility. So these are the items which is required to calculate Black-Scholes model. So out of these, which option is here? Discount rate, call market price, put market price, not option. These are price. So common stock price, right? Fourth option is correct. Make sense?
Yes sir, उसमें तभी आ जाएगा sir.
Last is ACME company issue 1000 face value of the bond that pay annual coupon rate of 6.5% and mature in 4 years. Assuming the market interest rate is 60% at the time of issuance, the bond price is closest to what? So first thing is market rate of interest is 6% and you are giving 6.5%. That means you will be charging premium, right? Yes or no?
Yes sir.
For example, in the normal market, the interest rate is 6% and you are paying 6.5% interest rate on the debentures, right? So your debenture will be on premium. Yes or no?
Yes sir.
So first and fourth option are incorrect, right? So at what
Sir, how do
value?
we get that 6%? Like
This 60%. This is 6%.
वही सर तभी confusion लग रहा है.
Right? So as you are paying more interest, so you will be issuing at premium. But now you need to calculate what premium. So the premium will be, for example, 1000 is the face value multiplied by 6.5%. That is $65.
Yes, sir.
right? $65 divided by 6%. How much is it?
One.
10
1083.
108. 1 second. So giving 0.65 divided by 0.06 multiplied 1083. So it is coming 1017. Yeah. Once again, the issue 1000 face value bond that pay the annual coupon of 6.5%. That is $65 is the interest we are paying and mature in 4 years. Mature in 4 years.
सर 1083 है ना, तो वो सर
Now
डिवाइडेड बाय 4 से करेंगे.
1083 minus 1000 divided by 4. So 1083, yeah. So it will be, because like it will be a compounding interest. In 4 years you will be paying 6.5%, right? So 6.5 divided by 4, your annual interest is 1.625, right? So that's how this 1017 is correct answer, third option, right? So we'll be dividing 83 by 4 basically, which is coming closer to 1017. Why 83? Because that's a cumulative. So if you don't do cumulative, it will be less.
Okay.
Right? So this is it for today class. So we'll catch up after the Diwali weekend now. Right? So we don't have any post-break class today. I'll send this notes to you and you guys can go through, and then after we'll catch up after the Diwali weekend. Right?
But next week we don't have any class, not neither on Saturday also.
Yeah, Saturday, Sunday is Diwali, so yeah, we may not have class for Diwali weekend. Right?
And when we are expecting